Imagine trying to launch a business that requires sending a fleet of massive wooden ships across the globe. In the 1600s, oceanic trade operations cost vastly more money than any single individual possessed. The Dutch East India Company needed to fund these expansive voyages to trade highly lucrative goods, specifically things like gold, spices, silks, and fine porcelain. To afford the massive upfront costs, the company turned to private citizens in European coffeehouses and shipping ports. They offered a simple deal: provide the money to fund the voyage now, and in exchange, receive a fractional share of whatever profits the ship brings back. By trading a portion of their initial financial risk for a piece of the future reward, both the company and their investors increased their overall wealth. In doing so, they unknowingly invented the mechanics of the world's first stock market. Fast forward to today, and that basic system of risk sharing has expanded into a massive global industry. There are entire university departments, dedicated lifelong careers, and television channels running 24/7 specifically dedicated to analyzing it. Yet, while the core objective remains identical to those 17th century voyages, the modern system is heavily obscured. It is buried under layers of complex financial jargon and chaotic daily market noise. Strip away the flashing tickers and talking heads, and we are left with a mechanical question. How exactly do companies and everyday investors actually use this market today? Imagine a successful new coffee company. The owners want to expand their operations globally, but they lack the capital to build new production facilities themselves. To raise capital, the company sponsors an initial public offering, or IPO, launching the private business onto the public market. Anyone who believes the business has a profitable future can buy a stock. By purchasing these individual units, investors secure partial ownership. The capital raised from these initial sales flows into the company's accounts, providing the immediate funding required to launch new global initiatives. When an investor buys a stock, they are directly injecting growth capital into a real-world business, exchanging their present-day money for a piece of the company's future success. As that freshly funded coffee company builds new facilities and increases its profits, other buyers notice the success and want to buy in. This animated graph illustrates the math. As demand rises for a limited stock supply, the share price rises directly alongside it, raising the total wealth of current owners. But if the company appears less profitable, investors sell off shares. Demand plummets, dragging share prices down. As those individual stock prices drop day by day, the overall market value of the entire company shrinks accordingly. While physical assets like real estate and inventory provide a baseline, a company's total market value serves as a real-time measurement of collective public belief in its future. That success is often dictated by tangible market forces. A company must constantly navigate the fluctuating prices of raw materials, shifts in global labor costs, and changes in production technology. But investors are equally influenced by intangible factors. A sudden change in corporate leadership, a wave of bad publicity, or shifting international trade policies can easily spook the public. This creates a psychological loop within the market. Human confidence is a surprisingly heavy weight. If a company simply appears to be losing value, it can trigger a sudden panic that leads to an actual, immediate loss of value. This unpredictable human variable explains why the market can shift so rapidly. Collective confidence has the power to drive broad economic growth or trigger a sudden financial crisis. Because daily market noise is constantly driven by unpredictable human emotion, trying to time the system for quick cash is dangerous. It is why financial professionals promote reliable, long-term investing over short-term bets. Despite its massive scale and volatility, the modern stock market remains open to investors far beyond the original circle of 17th century shipping magnates or Wall Street elites. The adoption of the internet changed the landscape. Today, everyday people can buy and sell stocks using the exact same methods as massive institutional investors. Financial experts and software developers are continuously building new tools designed to help anyone educate themselves and navigate this highly complex system. By understanding the mechanics of supply and demand, anyone can participate in this global risk-sharing engine. It is a direct way to support the businesses you believe in and actively pursue your own financial goals.